going to discuss Chapter 20, Master Budgets and Performance Planning. Budget, a short-term financial planning tool that typically covers 1 year. It is a company's formal statement of its future plans and is usually stated in financial terms such as dollars, lira, yen, whatever your financial method of statement is. In a recent study, it showed that the control function of budgeting is to use benchmarks. Most typically, these are past or historical performance and B, expected performance. The budgeting process has 3 very important guidelines. Scroll up. Employees affected by the budget should be consulted while the budget is being prepared. This is also known as participatory budgeting. A couple of sentences down, you can see where I see got to beat budget, got to beat the budget. One of the reasons that you have participatory budgeting is so that you have buy-in from the employees. There's nothing worse than handing an employee a budget saying, you got $12 to do $1 million worth of business with, get to going. Because that employee is going to look at you and go, how am I going to use $12 to make $1 million? So you want to have the employees that are affected by the budget involved with it. That helps them get buy-in and helps you set reasonable and attainable goals. And that's what the next part is. The goals reflected in the budget should be attainable. And then the final part, evaluation should be made carefully with opportunities to explain. That means that if there's a variation from the budget, you don't come in like Conan the Barbarian, start chopping heads off. You look to find out, why is there a problem here? What are we doing wrong here that we can do better elsewhere? And so that's why you want to have this 3-step budgeting process. And as I said before, a budget can be an extremely valuable tool for helping to motivate and to help produce buy-in from the team members affected by the budget, but it can also help cause and create unethical behavior when the only goal is got to beat the budget, got to beat the budget. And what I mean by that is then you get managers or people who have ways of influencing the financial statements as it concerns their department's budget, and they start fudging the numbers to beat the budget. Because a lot of times in companies you'll find that your bonuses are tied to budgets. So you have to be careful with how you prepare a budget, but also in how you incentivize that budget. Master budget components. Typically the master budget will consist of several other smaller budgets, which can then become the basis for budgeted financial statements, such as budgeted income statement. These help managers engaging the effectiveness of the master budget, as well as to help show when figures may need to change to meet an unforeseen demand. For example, you buy bamboo, and for some reason there's been a panda explosion in China, and there are millions of pandas wandering the bamboo forests, and they're eating up all the bamboo. Well, you're going to have to really change what your predicted cost on bamboo was, because there's been an unforeseen demand on bamboo. And I'm sorry if that sounded silly. Anyways, you have your operating budget, you have your sales budget, you have your merchandiser's budget, which is merchandise purchase, you have your manufacturer's sales budget, which is production units to be produced, manufacturing budget, manufacturing cost. You have your selling expense budget, your general and administrative expenses. These are all parts of your income statement, if you remember those. So it just kind of shows how these all work together. And then you have down here capital expenditures budget, which is expenditures for plant assets. Then you have financial budgets, cash budget, cash receipts. This is a very important concept. In businesses that may operate on different cycles, having cash on hand to be able to use it when a unforeseen opportunity comes up is extremely important. So your cash budget It's really important to understand that you want to keep enough cash to where you can take advantage of any opportunities without losing money by not investing it in some other product or in some other company or expanding your own operations or paying down your debt. There's a balance point in how much cash you need to keep on hand in the bank so that you can take advantage of unexpected opportunities, or you can pay a bill that might be net 320, which means you get a 3% discount if you pay it within 20 days. And say you spent $100,000, hey, $3,000 is nothing to sneeze at when you're looking at, percentage points as profits margins. Budgeted income statement, and then you have your budgeted balance sheet. There are a large variety of ways to budget for different types of inventory systems. Your company just needs to figure out its niche and what works for it. Especially since the advent of Walmart, just-in-time inventory has become real big in the manufacturing and in the selling environment. In this system, managers budget just enough inventory to stay a couple of days ahead of its customers' needs. Now, it used to be everybody worked off of the safety stock inventory system. They kept more stuff on hand than they had to keep because things happened. There wasn't the vast variety of technological solutions that there are now. And so they kept a stock of inventory, and this often led to extra warehouses having to be kept to keep the extra stock in. So there's different factors at play when you're trying to figure out what kind of inventory system to use, such as this. Okay, so I'm going to go over here to Excel, and I've prepared a income statement with variances from the original budget. Up here is merchandise purchases budget preparation. And this is the formula you would use to find out how much merchandise you would need to have done this. Inventory to be purchased equals budgeted ending inventory plus budgeted cost of sales for the period minus budgeted beginning inventory. Budgeted beginning inventory is last month's ending inventory. So budgeted beginning inventory is last month's ending inventory. Okay, so here I'm going to prepare a income statement with variance from the budget. I'm going to move this over a little bit so you can see the whole thing. There we go. So here we've got net sales, we've got actual net sales, we've got what we budgeted, and we've got what the variance is. We've got cost of goods sold, we've got gross profit, and then down here we've got all these other things from the income statement. So over here we budgeted $695,000 at Owl's House of Barbecue and Blues this year. Well, we actually had a much better year than we thought, and we actually did $785,000, which is a $90,000 variance. Next chapter we're going to cover whether this is a favorable or an unfavorable variance. This is a favorable variance, the $90,000. Cost of goods sold, $550,000. Well, that's what our actual is. Our budget was $550,000, but hey, we did $90,000 more than we thought we were going to do, so it's pretty reasonable to think that we would have had more, our cost of goods would have been higher than that. Now, a warning sign might have been if this number was, say, $450,000 and you had done $785,000, because then you'd want to ask yourself, well, where did all of this operating efficiency all of a sudden come from to where we made $335,000 when we normally only make $195,000 off the same kind of money. So these typically bear some form of relationship to each other that you can use to analyze. Now down here, like I said, we budgeted $500,000. So our actual gross profit for actual was $235,000. We budgeted $195,000, which means we had a $40,000 variance, which in this case, this would have been a favorable variance as well because we made more. But here, this $50,000 would be an unfavorable. So just keep in mind that what you're looking at is what the variance is right now. We're going to go into favorable and unfavorable more in chapter 21. Okay, operating expenses. We said we were going to spend $60,000 in operating salaries. We spent $62,500, again going with making more money than we had previously planned. That's fairly accurate to say that we would do that. Sales salaries, advertising. It looks like we spent $2,000 less than what we had budgeted. And down here for store supplies, looks like we used less store supplies than we normally did. Now these might have been concerning numbers, but I mean the value is so little that really it wouldn't be material. Material means 5% of your of your gross operating profit. So it's not enough to where I would go, yeah, I need to go find out why I used $2,000 less, or $500 or $300 here. So when you take away so what we budgeted, now depreciation should always be the same. So as you see here, we hit depreciation dead on, because depreciation of store equipment is going to depreciate it the same way unless we're using a different method other than straight line depreciation. And I should say that in this example I used straight line depreciation for everything. All right. So when we look down here, we have a $200 variance. Now this is an unfavorable variance because it's actually $200 more than what we would have used here. Then what we budgeted was $114,300. What we actually did was $114,500. So we say $200. It's really not a big deal, especially when you consider we made $40,000 extra that month. So now we go down here to general administrative expenses. Office salaries, we predicted $65,000. Probably because we did so much more business, we made our managers and our office people help out to help cover some of that. So we have a $7,500 variance there. Office supplies used, we actually used more office supplies than what we had budgeted. Again, this is our budgeted amount all the way down. And as you go across and you just look at the numbers, you can see that after everything, we had budgeted for $4,200 of gross profit for that month, or for that month ended. But we actually made $36,300, which would mean a variance of $32,100. Now that's a favorable variance. And remember, I was we're going to be talking about variance right here, which is chapter 21. But I'll go back and forth between these two when we're doing those. I'm going to go back to the Word document when we get ready to go over to chapter 21 next. But anyways, as you can see what the budgeted amount is, what the actuals are, and then you can see what the variants are. And those can help you, because now I can tell myself, I'm doing pretty good at budgeting salary. I'm doing not bad at budgeting anything here, really. The only big number that jumps out is that we actually did more money than we expected, and that's not a bad problem to have. I mean, for the total budget, there was a $7,900. For the total budget that we have, there is a total variance of $7,900 and a total operating expense, or I'm sorry, that's net income there, with a net income differential of $32,100. All right. This will conclude Chapter 20. If you have any questions, again, you can reach us at collat@uab.edu or on Skype at Collat_Tutor on Skype. Again, my name is Dennis Brooks, and this will finish this chapter. Thank you.